All right, everybody. Good evening. Welcome to this webinar organized by Vantage Broker in collaboration with OneClickFX, the Metatrader tool that makes your trading simple. Before we start, I have to warn you that Vantage Global Limited is authorized and regulated by the VFC SC. CFDs are complex instruments and come with high risk of losing capital rapidly due to leverage, and should always seek professional advice from qualified experts before undertaking any transactions in CFDs. Although Vantage Global Limited, the company, aims to ensure that the information material is accurate, it cannot be held responsible for any omissions, miscalculations, or mistakes, as it does not warrant the accuracy of such material. Any material and/or content provided herein is intended for educational purposes only and does not constitute investment advice on how clients should trade, as it does not take into consideration your personal objectives, financial circumstances, or needs. Please seek independent advice before making any trading decisions. Reliance on such material is solely at your own risk, and the company cannot be held responsible for any losses resulting directly or indirectly from such reliance. Past performance is not an indication of future results. With that said, we can go to the market, and I'd start by having a look at the US equity. As you can see today, the NASDAQ registered a net change above plus 2.5%. And this is basically due to the latest inflation data. US producer prices increased less than expected in October as services fell for the first time in nearly 2 years, of course, offering more evidence that inflation is starting to subside, potentially allowing the Federal Reserve to slow its aggressive pace of interest rate hikes. And of course, this is something, this is a rhetoric that started soon after the latest CPI data, also decreasing with respect to the previous numbers. Also, the report from the Labor Department on Tuesday, today, showed a decline in the cost of goods, excluding food and energy, reflecting, of course, improved supply chains, as well as slowing demand from higher borrowing costs. I had anticipated in the title of today's webinar that we would have made an operational session just after the release of all these macroeconomic data, which confirmed that maybe we are heading closer to a potential slowing down and then an end of the hiking cycle that has involved so far all the major central banks in the world. But we have examples such as the Australian central bank, which already slowed down the pace from certainly starting from the last meeting that was in October. Okay, and we see that clearly on the pair. Australian dollar, US dollar has been declining up until the release valve that was the CPI data of last week. It was then and only then that an increase of the Australian dollar suddenly started, and we saw this type of movement on any currency pair that involves the US dollar. Also, the euro dollar today reached above 104, which was a potential target, of course, for this week. If we look at the previous price action at the left side of our chart, but as usual, as you can see, our percentage levels provided by OneClickFX are an amazing reference to set entry points and also targets. As you can see, all the latest swing points actually formed, as I showed you in the previous webinars, exactly on our percentage levels. These are the daily ones, the one that move by 0.25 increments and are updated at the opening of every new Asian session. Of course, they start the calculation, the indicator starts the calculation from the previous daily close. And this is the grid, the operational grid that we see up to the hourly time frame. If we move to H4, we see the weekly levels, those calculated starting from the previous weekly close. And finally, on the daily time frame, we see the monthly level. And as you can see, the distance between the levels and the starting range differ a bit depending on the time horizon that is considered. So daily up to H1, weekly on H4, and monthly on the daily time frame. And this is what I was talking about. As you can see, we had a clear confluence of our percentage levels, the monthly ones on the euro dollar. The 5% mark and the 6% mark, respective prices are 103.76 and 104.75. And as you can see, if you highlight this area and you bring it back to the past, you realize that the 5% for the month of November is exactly in confluence with a previous swing high and two previous swing lows. So this was probably for the month of November, considering the expectations for a slowing inflation, a credible target for the pair. Of course, when we have two consecutive inflation data points that converge in signaling the slowing down of the inflation, which has been the issue and the main subject of the entire 2022, the market tends to exceed. And this is basically what happened after the first inflation data point, the CPI, and then after the PPI, we had probably the exhaustion of the move for the time being, which I'm very fond of right now, because I've been trying to intercept a rebound in the dollar for the past few days operatively, and I managed on various occasions. And this is the third attempt. I mean, I closed with a profit the previous operations on the euro dollar, basically, and dollar Swiss franc. But right now, in my live account, I have a long position here and a short position on the euro dollar. Dollar Swiss franc is already gaining something. Euro dollar is basically a break even. And from these levels, I expect a continuation of the pullback, and then we'll see what actually happens. On a weekly basis, as you can see, the market found its highs basically around the 1% mark. So as you can see, these levels are always defining for the market. I should have to repeat it every time, actually, because only by having a clear look at what happens historically, we can have a certain confidence then in trading these levels. And as you can see, I showed you the possibility of adding a custom number of previous analysis. So we can go 100 periods back if we like. Okay, no, not on this version. You can do it on yours. Sorry. And this makes us appreciate that every time the market swings, we are on some type of percentage level. And our job as traders with one-click effects is to actually understand on a daily, weekly, and monthly basis which are the reference points most that have the greater probability to see a rebound, a reaction anyways. So speaking about the euro dollar and of the daily grid, there's been a lot of volatility of late because of the macroeconomic releases, but on average, we can consider that on a daily basis, a 0.75 move on either side is usually what the euro dollar does. In the past few days, we saw plus 175, plus 150, plus 150. But of course, this is due to the macroeconomic releases. But when there are no potential earthquakes that might be generated from these type of events, on average, the euro dollar moves by 0.75% per day. Many times even less. If we want to put a number on this, we can say with absolute precision that the average daily range from high to low of the euro dollar is 99 pips. So 99 pips. Let's take today's range from high to low. And of course, you can find these numbers on my FX book if you don't have an indicator that highlights them. And as you can see, from low to high or high to low, the range of the euro dollar today was 168 pips, which means 69 pips in excess compared to the average. The average calculated on the past year of trading on the euro dollar, which means that after we are past our 100 pips mark from low to high, high to low, whichever you prefer, we start monitoring the market in order to take a contrarian position, in order to intercept the pullback, the correction from the highs of the day. Of course, sometimes it's a bit risky. Sometimes we have little margins, like here after the release of the CPI. As you can see, the market pulled back some 50 pips, and then the hike resumed. So it might be very risky after an important macroeconomic release, but if we are trading an ordinary market without the intervention of these types of events, of course, when we actually double the average range, we can look for the contrarian entry. Okay, it's this is basically the technique that I use for most of my trading. I'm not a trend follower, so I will not look for the types of entries that the percent pivot offers in the first part of the day, because this is an interesting instrument, because it allows us to trade in both directions of the market on an intraday basis, because we're always going to have a daily tendency and an extended move, average move, slightly above average, when we see a confluence at the weekly and monthly level. So, for example, the euro dollar is going up. This is quite evident. We have a plus 4.93 as a monthly net change. We're just above the previous weekly close, but there's a confluence, so it's moving up. So if the day starts with rises on the euro dollar and we have a clear trend at the monthly and weekly level, what we're going to do with this system in the first part of the day, meaning just after the first hour of the London negotiations, of course, the time varies depending on where you are, but let's give the Asians their range. Let's see what they do. And what they did after the CPI rise on this particular day was to test the daily support. Okay. rebound from there, and then go to break above the resistance, the daily resistance. Of course, we had monthly and weekly net changes lined up on the upside. So on this day, for example, the long setup, the trend following setup would have been perfect. Let's go to an even smaller time frame to see this particular price action, which is what we want to see before making our trade with this particular system. Of course, we go to M30, we go a little back. Here is definitely clearer, and this is the price action that I would have been looking at. Okay, so test of the support, the market goes slight below, goes back up, back above. And then there's this particular move, which is very interesting. And this is something that we want to see if we want to anticipate the entry. Let me take a drawing device so I can explain myself a little better. Okay, so this is the test of the support in confluence with a previous swing high, the one made after the inflation rally. We pull back, we go back above the daily support. Okay, and then we have this little test. Okay, the market pulls back after this small impulse, and it doesn't go back below the support. If we want to anticipate the entry, and of course, if we are awake at that time, which is highly unlikely if you're in Europe, because it was not even 5 a.m. So, but if you are one of those poor souls that many times spend their nights in front of the screen, like myself, you might even be in front of your monitor when this happens. So this would be an interesting opportunity, an interesting condition to anticipate the trend following long entry on a day like this one. Okay, but suppose we wake up at a normal time, and we see that the market, after the first hour of London negotiations, is attacking the resistance. At this point, and keep in mind that during all this time, we had a positive RSI reading. Okay, so an RSI above 50 on M30, and we can check, of course, the values of the RSI on every time frame. On this particular day and potential setup, it would be enough to check the values of the RSI, let's say from H4 or H1 and under. Okay, that would be sufficient in my opinion. So we wake up, our coffee in a mug in front of us, and we see that they are attacking the resistance, the daily resistance. In support, we have the RSI reading, and what happens is that they break, they go back, and again, what happened here happens again. One time and another time. 2 times the market, after the break above the resistance, tests the area, and we have a change of polarity as it's defined in trading. So the previous resistance, the potential resistance, turns into a support. And this is where we open the long position on the retest, hoping that the market will continue with the trend that has been announced for the day by a series of previous conditions, and also by the macroeconomic outlook and the reaction of the market to the inflation data, because it was clear that the market interpreted the inflation data as dollar bearish, of course, an excuse to take profits on the dollar, an excuse to take profits on the dollar, an excuse, of course, to increase the positions on the euro, because we have to keep in mind also, if we are those guys that also monitor the positioning of the institutional investors, the net shorts on the euro FX have subsided in the past weeks, maybe months. I don't remember exactly, but it's at least 4 weeks that the COT reports highlights how the net shorts from the large investors on the euro were on the way of disappearing, basically, of diminishing at least. So the COT report was talking of a possible reaction to the upside on the euro in the past few weeks. And then we had the occasion, the event that the market took as an occasion to actually produce the move. I have a demo account here, so I think and it changes. Okay, let's see. I have a brand new one, but I didn't do anything. So I suppose the advantage let the other expire and opened a new one for me. So I cannot open immediately a position because, after having briefly recapitulated how the system works, I'd like to do something on the operational side right now. So let's see. As I told you, there are two techniques that we can employ in a single trading day. We have the trend following, and then we have the contrarian. Today, I did the contrarian on the euro dollar, for example, and also on US dollar Swiss franc. I think even Australian dollar, US dollar could be interesting. We're still just below the highs. I don't really like the price action right here. But considering that it's 6 p.m. Where I'm from, and basically the daily moves already happened, at this point, at this particular hour of the day, with this system, we're going to look for the contrarian entries from the highs. And all we have to look for is for the biggest daily net changes, and those net changes that we recognize. So we can use the square dashboard to do that. We don't need to open all the single charts. We're going to open only the charts of those instruments that are actually around significant percentage marks. Okay, so for example, Australian dollar, Canadian dollar, sorry, I have to refresh the data, it's just below 1%. Okay, we had the same reaction that we had on the euro dollar. It's been going up for the past 4 days, so if it's not today, I'd look at it for a correction going towards the ending of the week, maybe tomorrow, more likely on Thursday or Friday if the tendency continues. On a daily basis, we might have a setup. Look at how the market reached in volatility, the 1% mark. So seeing this candle, this particular candle starting to take shape, a limit order on the 1% would have been great to intercept the first reaction. The market moved some 12 pips from the percentage level. We might even have room at this point, provided we had placed a limit order on the 1% to protect entirely the position by placing a break-even order. It's a bit risky, of course, because 12 pips is not enough. I could see maybe the third pullback of the highs before we actually correct. And our original setup with a limit order would have aimed at a correction towards the 0.75% mark. Okay, so a trade of potentially 22, 23 pips from the entry point. A stop loss placed up here would have given us a 1-to-1 risk reward. But the pullback already started, so I might want to, and also we have this this high here, which I don't particularly like. I mean, the intraday high was updated by 25 pips, but it was on the plus 0.75 that we had the first big correction. So I'm not expecting that the market is going to go back down here, and I don't want to enter the market here. So I'm going to look elsewhere, but this would have been an excellent entry point, okay? Probably already at break even. What I did just in the past hour is a short on Euro Canadian dollar. Because I was lucky enough, sorry, here we don't have the data. Perhaps I have to, okay, manually, okay. I was fortunate enough to find myself exactly here. So the market reached 0.75%, went down. So this would have been the first possible trade, but then it retested, and somewhere here I happened to open the chart. I was here and I placed a short, already closed, just a little bit above from current prices. So this one is not available anymore. But before starting the webinar, I was actually eyeing Euro New Zealand dollar. Euro New Zealand dollar saw a very volatile day, and we saw it reach the 0.75% mark in volatility. And actually the market, we can see it from the current hourly candlestick, is slowing down. This is the typical shape of a candle that tells you not to try to follow this move, at least on an intraday basis. So we're just below the 0.75% mark. We were a little bit late to open a position here. And as you can see, a first rebound already occurred. It was 30 pips. So at this point, I might actually wait for a new low or a close of this hourly candlestick above the previous high, low. Sorry. Okay. So I wanna buy this pair. I can do two or three things. I can see that the market is going to pull back some 56 pips from current levels, and I can buy it. We are also on a round level. We are at 1.68. So it's a nice number to aim for a rebound, of course, or I can wait for it to reach the -1% mark. At this point, I would be extremely confident in the possibility to take at least 50 pips from there. See, 45, 50 pips from here. Okay. The other option that I have is a buy stop order here above the confluence of the hourly high and the -0.75% mark. As I told you, this is a new account. So, okay, buy stop here. This could be a solution, because if the market rebounds from here, the buy order is activated with a green price action. We're starting to see something, and we are seeing a breaking condition, which is highlighted by this instrument here, which is not simply a time frame changer. It also tells us the conditions of the price action on every time frame, and we have different colors for different conditions. So this H1 dark green color highlights the fact that the previous hourly low was broken, and now we are back above, which means that probably the market is refusing lower levels. But we have to take into account the possibility that the market is going to extend somewhat, some 20-25 pips. So I'd say that the best solution of the three that I presented to you is, for starters, to place this order, okay? And then we're gonna have a take profit at 1.6854. Let's set it up. 1.68. All right. Modify. 1.68. I don't remember already. 45. Then we're gonna move it manually. So this could be a setup. As the buy order gets activated, we're going to place the stop loss ideally on the -1% mark. If we are those traders that use a stop loss, I, for example, do not use stop losses, which is very risky. I do not advise it, but my system implies some different type of management. I usually increase the size as the position goes against me. I basically double down, as they say, but it's done within a particular frame of reference. So I managed to swing it without using stop losses, which I don't feel comfortable with, as simple as that. The buy stop here allows us also to wait and see, because if the order gets activated and then the market rolls over again, we can then wait for the -1% mark to open the second position. Okay. If that doesn't happen, chances are we're gonna reach the target very quickly. We're gonna see a rebound after the market made a daily range of 164 pips against an average of 158. Okay, so we are just below, just above the average. And also, if we look here, we already just broke a previous price structure, a previous swing low, which makes this breakout to the downside very interesting, because usually these are typical bear traps. So the market broke below an important support that has held for days to this point. I'm going to open a short position because it broke. This is a technique employed by various traders. Of course, doing it at this time of the day would be actually a rookie mistake, but we also have to take into consideration that there are automatic systems out there that are working constantly, and many of them are programmed to make these entries. Okay, so we have sell stops below important lows, buy stops above important highs. So usually below these lows and above these highs, we have a pool of liquidity. And usually when we have a breakout, which is not due to, for example, a macroeconomic release, the market tends to pull back before eventually taking the direction of the breakout, if that is what has to happen. Okay, so the fact that we broke this low, the fact that we are above the previous hourly low after a breakout, makes me want to place an order on a pair. Also did it on my live account. We're going to see what happens. So this is one of the pairs that at this point I find interesting. Also, we have pound US dollar plus 1.09% for the day. Of course, we open the chart, we see that this is basically misleading information, because the market did 2.25%, already pulled back. There's no place to open a short right now. Chances are that if the US dollar has to rebound, we're going to have an opportunity as the market retraces the first bearish impulse. So we would be looking at the area of the 50% retracement, maybe 618 retracement. So between 119.40 and 119.60 as a potential sell entry zone. Okay, right now I wouldn't touch it. I'm kind of regretting I wasn't in front of the screen to see this plus 2.25, because it would have been a very nice short entry. I would have probably aimed at a 1% retracement after such a move, and they would have been 90 pips. Okay, but I have a short on the euro dollar. I have a long on US dollar Swiss franc. So I wasn't really looking to add to my exposition. No, that's not the word. To my to the risk that I already had on this US dollar rebound. If we look at the index, we can see that the daily candlestick of the DXY also tells us that the first portion of the correction is maybe slowing down, just about a previous swing low. Reference 104.56, more or less. Okay, let's see. The low is at 104.63. So starting to open a position in view of a rebound of the US dollar up to here, I think is sensible. I'm not sure that we're not going to test this low. And when I'm not sure that that something like this is going to happen, I usually start building the position employing half a size compared to my usual. So when I trade Forex pairs, I regularly open a mini lot to start, okay, unless the excess that the market produced is already particularly great, particularly evident. So in this case, I would probably open a 0.05, only to wait the breakout, the false breakout, I would hope, of this previous low to open an entire size. Okay, so the usual mini lot, which would add to the previous 0.05 and hopefully would increase the profit of the rebound operation, let's call it that, because I expect that after this weekly candle and after potentially a false breakout of the previous weekly low, we're going to have a rebound. I don't know if it's going to be sustained. I don't know if the market already priced in the slowing down of the Federal Reserve rate hikes, but I'm a short-term trader. So I'm really interested, for example, in US dollar Swiss franc of this particular move. So the market from the latest important swing point lost 550 pips. So I'm looking for a rebound of some 200 pips. I started buying on Friday, and then I bought again today, and I'm looking for this type of correction, okay? If it's gonna go to new lows, I'm gonna buy again, because the rebound of the dollar in the short term is imminent, okay? It might be already started, but I don't wanna miss it. I've been able to buy the dollar and make money in the past few days, let's say here, let's say, okay? So I also wanna cash in on the third portion of the rebound, and I expect this to be the wider one, okay, the most interesting. So I'm not looking to close my short on euro dollar or my long on US dollar Swiss franc. Let's wait and see. Also, I can afford to do it because my exposure is not that great. So let's see, New Zealand dollar, Canadian dollar. To see you still there, because I wanted to see in closing for this webinar two other pairs that might be interesting at this point. Let me see if I can manage, because it's quite okay. We're here. So New Zealand dollar, Swiss franc. I want to see it on a daily basis. Okay. Please help me, platform. It's just a couple more minutes. Okay. Plus 150% on a previous swing point, and the daily range is of 96 pips against New Zealand dollar, Swiss franc, an average of 61. So this, in my view, is an opportunity. I would open a short position, this 1.41% mark. I actually, okay, press the button. Now it happened. And I would try to take this type of move towards the 1% mark. Okay. This high was actually broken. The market fell below. And I would also, in case it was to go against me right now, open a second short position at 0.5848 here on the 175% mark, because we have previous price structure. As you can see here, it was a previous support. If the reaction does not happen from this swing high, most certainly it's going to happen from here, okay? Unless something really remarkable happens today. Maybe the NASDAQ does another plus 4% and the New Zealand dollar flies. But I think that a position here within mind to open a second one here could be a nice way to trade New Zealand dollar, Swiss franc in the next few hours. And then we also have New Zealand dollar, US dollar plus 1.3, but I don't like it because it already pulled back from the plus 175. So the trade already happened. We might wait and see if it happens again. If the market goes, I'd say rapidly to retest the daily highs, we might have a second opportunity. If this doesn't happen, I would leave it as it is. Of course, this, as the one we saw on pound US dollar, is a lost opportunity. Let's see if there is something else that might be interesting here. So as you can see, pound Swiss franc. This happens almost invariably. We already have to mind particular market conditions. But after this type of move, 220 pips, the move ends basically on a previous price structure on a percentage level, and pound Swiss franc, we are above the daily average, which is of 106 pips. Today we made 225, so more than double. We can have a quick opportunity to make 50, 60, 70 pips on the more volatile currency pairs. On the euro dollar, pound US dollar, usually the opportunity is between the 25 and 50 pips range. But this is something, and this is my trading system that I actually conduct using the percent pivot that allows us to find multiple setups of this kind every day. So if we can count on something like this, if we know that at least 4 setups of from 30 to 60 pips are going to present themselves on these types of moves, of course, we can start to plan and give a value to these pips. So suppose I can for sure intercept 4 times a 25% pips move with a setup similar to this one. This means that I can make 100 pips per day. So if I use a 0.1 size, a mini lot, well, it means that I can make $100 per day, which means $500 per week, which is how I started when I discovered the efficacy of these levels. I understood that the ability on these levels to catch these types of moves is quite constant. Every day I get setups, and so all it took was to define how much money I would like to make. So based on that, I elected the size, the standard size, and I started to execute this program. And with one-click effects, with the percent pivot, everybody can do it. Of course, sometimes we're gonna find appropriate to short the market here, okay, to catch 50, 60 pips, and the market is going to keep going, okay? And maybe the day after is going to keep going. So we are with a short opened here or here, and the market the day after is up here. This is what happens, this is what can happen, and this is what has to be managed, okay? And it has to be managed in a way that if something like this happens, the day after, I won't be in the position not to be able to trade the other setups that present themselves, okay? And I also have to manage it in a way that a move that starts and never goes back, which happens quite often, is not gonna annihilate my account. This is the other thing. So I'm proposing basically a contrarian strategy that you might have a look at in the next few days and the next few weeks. And I'm also signaling the dangers associated with it, strategy with the help of the stop loss orders would be really appropriate for sure in the early stages. But this is something that actually works, and I am happy to share this with everyone that listens to me, because it does great things for me. It also put me in danger, caused me some damage. This has to be clear. But this is something that might work if we find our way to make it work. And the alternative is, or the thing that we can add to this is, of course, the trend following setup that we had, for example, on pound Swiss franc, evidently, even today, okay? So the break above, the market pulls back, but the resistance becomes support and the market shuts up, reaching the previous price structure in confluence with our percentage levels. So you decide you want to follow the trend, follow the tendency of the period. It can be the week, it can be the month, it can be the day, according to your availability of time, to your habits. of course. But what I am suggesting here, most of all, is to have a clear objective of how much money you want to make per time span. So how much do I want to make in a day, in a week, in a month? Okay. Once I know that, I can start to plan my types of entry to realize that objective. So let's say I want to make 100 pips per day. So I have to make 4 trades of 25 pips. So I need an entry style that allows me to find setups of 25 pips at a time. And I want to find 4 of them each day, every day. Okay. This is a great way, in my opinion, to become a trader and to have trading as actually a resource. Of course, on paper, it might sound easy. It's not. It's always a battle, okay? And the risk associated with it are quite real. I'm sure you know that. All I can do is give you the instruments that are going to put you in a position to actually have an entry checklist. We want to see the breakouts, the changes of polarity. We want the support of the algorithmic analysis, etc., for the trend following and for the contrarian entries. And an idea of how I became a trader, which was how much I really want to make from this thing. And that gave me a mental order, because this is my objective. How can I reach it in small portions? Every day I have to do this. Every week I have to do that. Every month, at the end of the month, I want to see my results, which is built throughout the month with small portions, with small trades that, in my opinion, and according in my experience with the system, are high probability ones. Okay. So I hope this was interesting for you today. If we are going to see each other next week, we're going to also have a look at the position I opened today. I think it was just the one, actually. Okay, let's see if that actually pans out. No, 2. New Zealand dollar, Swiss franc, and euro, New Zealand dollar. And we'll go from there. And if you're gonna be here next week, next month, actually, the next appointment, I'd like to hear from you if you tried the strategy, if it produced interesting results, or if not, we can discuss it together and see what the problem might be. I want to wish you a really great evening. If you are tennis fans, you're probably going to look forward for tonight's match. I think Djokovic plays again, if I'm not mistaken. I'm looking forward to it, but I also have another 2 webinars right around the time. So I'm going to see the recording. Good evening, everybody. Thanks for being here. And I look forward to seeing you at our next webinar. Goodbye.